A city built on impossible ambition. Glass towers rising out of the desert, reflecting sunlight like something engineered to look permanent. Luxury everywhere you turn. Marble lobbies, infinity pools, penthouses priced higher than entire neighborhoods in other countries. It feels complete, finished, like a place that has already won. But beneath that polished surface, something else is forming. Something you can't see from the outside. A gap, a growing imbalance, not in design, not in architecture, but in value. And that gap is now being measured in numbers that sound almost unreal. Nearly $100 billion tied up in real estate that isn't behaving the way it was supposed to. So here's the question nobody is asking out loud. What happens when a city built on constant growth reaches a point where that growth no longer supports itself? Because this isn't about one failed project or a temporary slowdown. This is about a system that may have pushed too far, too fast, and is now facing the consequences in ways that are only just starting to become visible. For years, Dubai sold a very specific kind of dream. Not just luxury, but certainty. The idea that if you entered the market, you would win. Buy property, hold it for a short time, and watch the value rise. It felt predictable, almost guaranteed. Developers reinforced that belief with aggressive marketing, promises of steady rental income, projections of rapid appreciation. Banks supported it with accessible financing structures, and real estate agents framed it as a once-in-a-generation opportunity. It wasn't just about owning property, it was about participating in something that seemed unstoppable. And for a while, that belief was rewarded. Prices climbed. Projects sold out before construction even began. Early investors made significant returns. The system appeared to validate itself, but what made it feel safe was also what made it fragile, because the entire structure depended on one assumption staying true forever. That demand would always be there, that someone would always be willing to buy at a higher price, and that the momentum driving the market would never slow down. The first signs of imbalance didn't look like failure. They looked like success taken to an extreme. Between 2020 and 2022, Dubai experienced a surge of global investment unlike anything it had seen before. Wealth moved quickly. Modern Dubai positioned itself as a stable destination in an uncertain world. Developers responded immediately. New projects were announced in rapid succession. Entire districts were planned, launched, and marketed almost simultaneously. On the surface, it looked like expansion, progress, confidence. But underneath, the nature of demand had changed. These properties were not being built primarily for people who intended to live in them. They were being built for investors, buyers whose goal was not usage but resale. Units were purchased off-plan, often resold before completion, sometimes multiple times. Each transaction pushed the price higher. Each sale reinforced the belief that demand was strong. But what it actually created was a feedback loop. Prices rising not because of real occupancy needs, but because of speculation. And speculation, by definition, is temporary. That is where the system begins to shift, because real estate, at its core, depends on usage, people living in units, renting them, creating consistent demand over time. But when a market becomes dominated by investors who never intend to occupy the space, that foundation weakens. In Dubai's case, properties began changing hands repeatedly before they were even finished. The value of the asset was no longer tied to its function as a home, but to its perceived future price. And as long as prices kept rising, the system held together. But once that momentum slows, the weakness becomes visible, because suddenly there are too many units and not enough people who actually need them. What once looked like demand reveals itself as something else entirely, momentum without substance. And when that realization starts to spread, it doesn't just affect prices, it affects confidence. And confidence is what holds speculative markets together. By 2023 and 2024, the numbers began to reflect what the structure could no longer hide. Supply had expanded aggressively, but real demand had not kept pace. In fact, completion rates began to outpace actual buyer demand by a significant margin. For every individual looking to live in a property, multiple units were available. Entire segments of the market, especially in the luxury category, began to experience declining occupancy. Buildings that were expected to operate at near full capacity were functioning at partial usage. From the outside, nothing seemed wrong. Lights were still on, services were still running, but internally the imbalance was clear. Revenue projections were no longer matching reality. Rental yields began to drop. Units remained unoccupied for extended periods. and the gap between what was built and what was needed continued to widen. This is not the kind of shift that happens suddenly. It develops quietly until the numbers become too large to ignore. This is where the concept of a financial black hole begins to make sense, because when properties fail to generate expected returns, they don't simply become neutral assets. They become liabilities. Loans still need to be repaid. Maintenance costs still accumulate. Operational expenses continue regardless of occupancy. Across Dubai, tens of billions of dollars are now tied up in real estate that is underperforming relative to initial projections. And when you account for financing structures, developer exposure, and investor commitments, the total financial weight approaches levels that are difficult to absorb without adjustment. This is not about buildings being empty in a visible way. It is about capital being locked in assets that are not producing the value they were designed to generate. And when enough capital becomes trapped like that, it affects the entire system. Not just developers or investors, but the financial institutions connected to them. What makes this situation more complex is that the system itself encourages continuation. Many development models rely on upfront payments during construction. Buyers commit a portion of the total price early, which provides developers with the capital needed to complete projects. This structure works well in a rising market, but in a slowing one, it creates a different incentive. Projects continue even when demand weakens, because the funding has already been secured. That means more supply enters a market that is already struggling to absorb existing inventory. Instead of correcting quickly, the imbalance extends over time. More units are completed, more pressure builds, and the adjustment that eventually comes becomes larger. This is one of the reasons why the situation can appear stable on the surface, even as underlying conditions shift. The system does not stop immediately. It continues, even when the signals suggest it should slow down. At the same time, external factors are adding additional pressure. Tourism, which plays a significant role in supporting short-term rental demand, has begun to shift. Visitor patterns are changing, preferences are evolving, costs are rising, and competition from other global destinations is increasing. This affects not only hotels, but also private property owners who depend on short-term rental income to justify their investments. When occupancy declines, or when pricing becomes less competitive, those revenue streams weaken. And for investors who relied on those projections, the impact is direct. Lower income, longer vacancy periods, reduced returns. This does not immediately create a crisis, but it contributes to the broader imbalance. Because when multiple parts of the system begin to experience pressure at the same time, the overall structure becomes less stable. The human impact of this shift is often less visible, but equally important. Workers connected to construction, hospitality, and property management begin to feel the effects first. Fewer new projects mean fewer opportunities. Slower activity reduces demand for services. Small businesses that depend on consistent foot traffic experience declines. Investors who entered the market expecting predictable returns find themselves holding assets that are difficult to sell or rent. And residents, particularly those living in partially occupied buildings, face higher costs as maintenance expenses are distributed across fewer occupants. These effects do not always make headlines, but they represent the real-world consequences of structural imbalance. Because behind every data point, there are individuals adjusting to a reality that no longer matches the expectations they were given. This is also why the situation extends beyond Dubai itself. The model that drove this growth is not unique. Cities around the world have adopted similar approaches: large-scale development, investor-driven demand, rapid expansion based on future projections. In many cases, these strategies have produced impressive short-term results, but they also carry similar risks. When growth is driven more by expectation than by usage, the system becomes sensitive to changes in momentum. Dubai's situation is not an isolated case. It is an early example of what can happen when expansion outpaces sustainable demand. And because it developed at such a rapid scale, the effects are more visible. It provides a reference point, a case study, not necessarily of failure, but of transition. At its core, this is a question of how capital is used. When large amounts of money are directed toward assets that are not fully utilized, the efficiency of that system comes into question. Housing, in its most basic form, is meant to be used, lived in, occupied. But when it becomes primarily a financial instrument, its function changes. And when that shift becomes too extreme, the balance between investment and utility begins to break down. The result is a landscape where value exists on paper, but not always in practice. And that gap is what creates instability. Because markets can adjust to changing conditions, but they require time, transparency, and often correction. So when you look at Dubai's skyline now, it still appears the same. The buildings are there. The design is intact. The image remains powerful, but the meaning behind it is evolving. The question is no longer just about growth. It is about sustainability. About whether the system can adapt to a reality where expansion is no longer unlimited, and whether the balance between investment and actual use can be restored. Because what we are seeing is not necessarily an ending, it is a shift, a movement from one phase to another, and how that transition is managed will determine what comes next. So the question remains, is this simply a temporary imbalance that will correct over time? Or is it the early stage of a deeper structural change that will reshape how cities like Dubai grow in the future? The answer is not immediate, but the signals are already there. And as they become clearer, the conversation will shift from what was built to what can actually be sustained. So, what do you think? Is this a temporary imbalance or the beginning of something much bigger? Drop your thoughts below. And if you want more deep investigations into the stories hiding behind global success, subscribe to channel. Because sometimes, the biggest problems are the ones you can't see until it's too late.